Super excited to be coming to you live today. This is the first time I'm doing this, by the way, so I have no idea if this is gonna work. So I want to make sure that this live stream and everything is working. It looks like I'm connected on YouTube already, which is sweet. And I think I'm waiting to get connected onto LinkedIn. So I'm gonna hold on a second. Uh, just to make sure. Why is it taking so long? That's not good. Hopefully this doesn't take too long here to connect to LinkedIn. Let me just make sure that the YouTube live stream is working while I'm at it, and then we can get rolling here. Get rolling. So let's see, live hotel. Yeah, it is. That is working. It's working on YouTube. That's cool. All right, now let's see if it's working on LinkedIn. Yes. Boom. Cool. It's so meta. I'm like watching myself on LinkedIn. Okay, cool. Now that I know that it's working, uh, anyone who's hopping on right now, thanks for joining. And decided that starting this quarter, I'm going to be doing a live hotel underwriting session every single week. So welcome to episode 1 of our live hotel underwriting sessions. Just a couple ground rules here. I'm not going to reveal the name of the asset, nor am I going to reveal details that would give away exactly where what the hotel is. I've signed a lot of these hotels that I will be underwriting for you. I've signed NDAs. That being said, most of the hotels that I will underwrite are hotels that came to me several years ago, and I signed NDAs for. But even though the NDA expired by now for these, just out of respect and to make sure that I'm not, just making sure that I'm dotting my I's and crossing my T's. Gonna, out of an abundance of caution, not going to reveal too much information here. But I want to walk you through the process. And of course, I want to make this as interactive as possible. So if you've got comments, if you've got questions, make sure to leave them in the chat. I'm not exactly sure how this works. So I'm not sure if I'm going to get notified with your questions in real time. Hopefully, me and my team can figure out how to make this an interactive event. And if you have a hotel that you would like me to underwrite for you, I am happy to do that. I will not sign an NDA though, because I'm not going to put myself on the hook for that. So if you have signed an NDA, or if it's your hotel and you want me to underwrite it for you, happy to lend my expertise and happy to do it live here. In fact, the only way I will underwrite it for you is if we do it live for everyone to see. So with that being said, let's dive into this one. So this asset here, this is a Marriott extended stay on the East Coast. I would consider the city a tier 2 city. It is not a tier 1 city, but it is a solid tier 2 with very stable demand drivers in the area, and demand drivers that would support an extended stay hotel. One of the things that I really look at when evaluating any hotel is whether the demand drivers, the economic drivers in that particular market, support the asset type. An extended stay. What are things that support extended stay? Business travel, right? Consistent corporate travel in and out of the area. If it's near a hospital or several hospitals, that's always great. Universities are also great for that. Military bases. These are things that support extended stay properties. Any type of travel where visitors are going to be staying for more than a couple of days. Transient activity. 2 nights, maybe 3 nights. In and out. A lot of people will not opt for an extended stay because they don't really need the kitchenette, unless the pricing's good, right? But typically, we're going to see a lot of guests, a lot of travelers that are booking for 7+ days, 5 to 7+ days in an extended stay. So, anyways, just a couple things here. This is my model, by the way. So, this is a model that I've put together over the last couple of years, and I try and make it really easy for myself. So this model's probably going to look like, um, yeah, it's going to look super super simple, and that's because I've made it simple. So I took a lot of the inputs that need to be put in here, and I put it basically all on one page, and it's going to be easier for me, and it's going to be easier for you to understand as well. So this hotel is being offered at 21 mil. Um, so we're just going to put that one in here. Typical brand fees for this, we're seeing anywhere from like 100 to 250 depending on the brand. But I always like to be conservative when underwriting these sorts of things, so I'm just going to put 250 in here, and like understanding that like we could pretty much get lower brand fees, but want to make sure that we're being as conservative as possible. Broker fees, typically, on the broker side of things, we're looking at anywhere from 150, 1 to 2 basis points. So we're gonna go somewhere in the middle here for this one. I'm just gonna put 150,000. Due diligence costs, we're looking at somewhere around 100 grand or so. So we can put 100 grand in there. And closing costs, so closing costs will probably be somewhere. I like to go around 1% for closing costs just to be conservative. So we're going to put 200,000 there. All right. So ADR, average daily rate. These are things that we need to look at the STAR report for. So here I have the STAR report for this particular property. Again, I want to remind everyone, this is not something that's active right now. This property was shopped, I think, in 2023 or so, maybe 24. So it's been a while. And the STAR report, the last STAR report we have here is for January of 2024. Okay, yeah, so I think it was early 2024 that this was being shopped around. Anyways, best way to get the ADR information, I typically look at my property running 12 months. The average ADR is going to be around 173. So we will put 173 here. And can we come back here? 173. Occupancy. So let's go back to occupancy. Running 12 months is around 82%. So we'll come here. We want to take what the property is actually doing right now. Something that I see some operators do, which I don't really understand why, is they inflate either the ADR, the occupancy, or the overall RevPAR in year one of their assumptions, or year zero, the base year rather, which makes zero sense to me. So, like, what are you gonna do pre-closing that's going to magically get these numbers up? So, that's a red flag for me. If we're seeing base assumptions that are higher than the STAR report, now there's nothing wrong with going lower. Right? I want to be clear. Like, there's nothing wrong with like building it a little safety net there. That's nice and conservative, but there's also nothing wrong with just putting it right where the market's at right now. Unless unless there's something that's happening, like, hey, the second that we get in there, we're going to take half the rooms offline to start the PIP. Okay, great. Well, if we're going to start the PIP, and for those of you that don't understand what that word means, it's property improvement plan, aka renovations, aka CapEx, right? So we're going to start the CapEx. We're going to start the PIP like day one, the base year, right? Okay, then maybe it makes sense to get rid of maybe like have the occupancy. I mean, 82 will make it 41% because we know there's going to be a bunch of rooms taken offline right away. So anyways, we can move on here. Keys. So this is 100 doors. Okay. Okay, so this cap, in my model, the way that I've written this is we look at what we believe the exit cap is going to be for the property. Now, an extended stay Marriott in a tier two city um, could fetch anywhere between, on the very low end, a seven cap, maybe all the way to 9 to 10. Uh, I can't divulge too much, but I will say that based on my analysis and based on the location, based on the fact that this is going to undergo a PIP pretty much day one, right? Well, we're not going to start the PIP day one. Sorry, we're going to start the PIP probably like 6 to 12 months in, right? There's going to be a procurement period and everything, but like eventually there'll be a PIP. So cap rate is going to be somewhere around an 8, and that's where I would recommend keeping it. Okay. So if we were selling a hotel that needed a PIP at the end of it, then the exit cap might be closer to a 9 or a 10. But this is a really solid asset you guys are going to see. So because of that, I think that we can comfortably say that that an 8 cap is feasible in this case. Okay, F&B revenue. So this is something that we're going to need to go into the P&L for. And this is the P&L for the property. We want to go into our, okay, hold on a second. Yeah. So this, as an extended stay, this is not going to have, any F&B revenue per se. Now, if you notice, there's a complementary F&B line here on the rooms expense item. So there's an expense for F&B, but I'm not really seeing any income here for F&B. So we're just going to put it at 0. Again, most extended stays and limited stays are going to extended stays and limited service. Oh my goodness. I think I need more coffee. Hold on. Okay. So F&B revenue, we're just going to keep it at 0. Other revenues. So we can come in here. So other operated departments, miscellaneous income. All right. So hold on a second. I think I have the wrong P&L here, don't I? Oh, goodness. Okay. Yeah, this is the wrong P&L. Unfortunate. So, and unfortunately, I did not redact the correct P&L. So you guys are just going to have to take my word for it, okay? So this is only the first month. I was like, hold on a second. Total operating revenue, 352. Okay, so I did not have my team redact the correct P&L. But I have the numbers here, so you guys are just going to have to trust me. But I can still share with you, so just kind of go through the exercise here, right? Like, so here we have our rooms revenue, right? And then we have our operated departments and miscellaneous income. So we would just take these two numbers, right? And we would add those up, and that would be the revenue, the other revenue, so to speak, right? Now, in 2023, for the full year, the other revenue was around 70,000. Now, if we do the math here, 12, so 12 times 12 is 144,000. So clearly, the revenue, the ancillary revenue, the miscellaneous revenue that was achieved by this hotel in January of 2024 was kind of like above the median, above the average, at least when comparing it to the T12, but we're just going to put 70,000 here. That is the other. Now we select extended stay. Notice how this model, I have like limited or select service, full service, and extended stay. So we know based on based on my experience, our target margin, our target EBITDA margin is going to be somewhere around 40%, right? After all of our expenses. Okay, so coming down to our, okay, goodness, where is it? Coming down to our financing information. So for this hotel, we're probably looking closer to 40% on the down, all right? And 7.5% interest rate should be doable on this one. And we're gonna calculate an amortized loan, no interest reserves. We should be fine because the PIP on this one, just even though we are gonna do a PIP, like the PIP would be done in phases, and there should be relatively little displacement. And so because of the way that the PIP is being done on this particular asset, we could still run the hotel. Basically, the hotel could be run pretty much without any sort of disturbance, right? So no interest reserve would be needed. Assuming a 1% broker fee on the loan and a 25-year AM on the note. All right, coming over to PIP. So this particular asset, there was a PIP. We had a third party. Group come in and assess the hotel. The seller already had a PIP that was ordered previously. So they took what they knew, they took what they had from the seller, and they walked the property, got a estimate of around $52,000 per key, okay, on the renovation, which is pretty hefty, honestly. But there's a lot of FF&E that needs, basically the whole property, right? The whole room needs to be gutted. And there's some common areas that also need to be renovated as well. So 52,000 a key comes out to 5.2 million on the reno, all right? And just to be safe, you're gonna wanna do about a 15% reserve. So just to round up, let's make it easy. We'll do a $800,000 construction reserve, all right? Even though, so just FYI, this third party group, when they give you a bid, they're the project manager. And so effectively the bid has built-in spread on it. And if they go over budget, they cover the difference. So in reality, unless something major were to come up, some sort of like unforeseen whatever, 52,000 a key would be the actual amount that was paid. Because again, if they miscalculate, it's on them. At least that's how it's working. I feel like I'm talking into the abyss right now. I hope not. I hope that there's people watching. And I just don't know if I can, I'm not sure if I can like see comments on here. Again, this is my first time doing this. I've never done this before. So let me see. I feel like I'm talking. Okay. Yeah. So I don't see any. Yeah. Well, tis what it is. So based on the fact that this is an extended stay property, we have our rooms expense estimate, but what we are now going to do, okay, and I'm just going to kind of put these side by side. Oh, that's right, the P&L. Darn. Okay. So what we're going to do next is we are going to go into our expense columns here and figure out, okay, are the different what are the different expenses based on like what are the different expenses as a percentage, right? Expressed as a percentage. So here you see like rooms expense in January. Rooms expense in January was about 25%. Now I know that in 2023, the rooms expense was actually 21%. So we're going to, oops, not do that. We're going to come in here and do 21%. F&B, well, it doesn't really matter because F&B, there's no F&B, so it doesn't, we can just leave that blank. Miscellaneous was around 50. And here we have our like total other other operated apartments. We have 2,000, right? But there's no miscellaneous income here. So based on my calculations, in 2023, miscellaneous expenses was actually like way lower than 50%. I think it was like 20%, but I just brought it up to 50 just to be conservative here. Okay. Now we have our A&G. A&G, this line item here, we have 11%. Again, these numbers are all off because this is just 1 month of data. But on the 2023 P&L, which I do apologize, I don't have that one. So we're gonna have to work with this one, but I do have the numbers, and A&G was around 7%, okay? IT, so this is around 2% here. We had it at around 3% in 2023. Marketing and franchise fees. So a lot of times you're going to see marketing and franchise fees separated out. And sometimes you'll see all of the marketing expenses rolled into the franchise fee line item. So looking at sales and marketing, right? So sales and marketing is 14%, right? So in this case, we actually have sales and marketing. We have the franchise fees rolled into the sales and marketing line item, but we know that if we siphon those two out, and we can actually go down here, for example, no. Rooms revenue. A&G, IT, sales and marketing. Yes, you'll see here franchise royalties, franchise affiliation marketing. You'll start to see all of that kind of broken out in different lines. So estimated the total franchise fees to be around 9, marketing to be about 4, and that's around 13% total. Maintenance was around 5%. Okay, come back up here. Maintenance. So property operations maintenance, here it says around 3%, but in 2023 it was around 6, and utilities around 6. In 2023 it was around 5. Taxes, so taxes 7.33%. In 2023, the tax rate was around 4. In insurance, is around 3%, but in 2023 it was around 2. So anyways, we took the assumptions from the previous year, or we made these assumptions based off of the previous year's P&L. Inflation assumptions. Right now, I'm assuming about a 1% increase in inflation. You'll see how this all comes together. Do we think inflation is actually going to be 1%? Probably not. It might be more. But we're looking at inflation as it relates to expenses, but also as it relates to ADR growth. So we can go in there and like manually adjust some of these things. You'll see how this kind of all comes together. Anyways, we're just going to say April 11 underwriting. And our base year is 2025. Okay, so the sponsor on this deal wanted a 2% acquisition fee, a 2% asset management fee. They wanted 300 grand on the construction management fee. And then you're going to see a 1% disposition fee. All right. This is what we have right now. Obviously this doesn't look that great, and we'll we'll kind of cross that bridge when we get there. But this is our sources and uses. It looks like PIP, hotel, acquisition, everything. It's gonna come to around 28 million or so at the current price, right? So if they can get it for less, then great. Here we have a bunch of assumptions and whatnot, and we can manually override. So this part of the model, I could override if I needed like A and G to be whatever, 6 or 5, but it's just better to do it in here because this actually sinks right into here. All right. Okie doke. So now we get to go to the pro forma, and this pro forma, this is all copyrighted. So I know for sure someone's going to be like, hey, can I get a copy of your model? No. And it's because most of this is like stuff that I got from my time at Cornell. And so they have a copyright on these things. So I can use them. That's because I pay for the course. So if you want them, you can pay for them and go to Cornell. All right, so I am here inside the pro forma. Now, what we want to do is we just want to make sure that our expenses are staying pretty consistent. Sometimes with these sorts of things, we can see sometimes the calculations get a little messed up. So I just want to make sure that as a percentage, we're seeing our expenses stay relatively the same. Like I don't want to see rooms expense go from 21% to like by year 7, like 19 or 18, right? We want our expense ratios to stay pretty consistent. As you can see, they're staying consistent here, right? Now, like I mentioned before, there are going to be times where displacement is actually going to impact our occupancy rate. In this scenario, based off of how many rooms could be pipped at a time, there would be a way to effectively like mitigate displacement. Now, are we going to have some displacement? Yes. And we could underwrite for that. So like if we wanted to be super conservative, during years, let's say 2026 and 2027, we could bring down our occupancy by say 5%, right? Maybe like 5% of the rooms are going to be taken offline. Now, are we sold out every single night? No, obviously not, right? So it's not really going to be 5%. It's going to be like maybe 2%. And could we make up for that on other days, or could we make up for that in some other way? Yes. So we could actually come in here, and if we want to be, like I said, super conservative, and we should be, we can come in here and say 77% occupancy. And oops, let me go back here. So we want this to be, we'll come back here. We'll say 83 here. So we're going to manually override this. And then we're going to just go 77 and 77, right, for these 2 years while the PIP is being done. And then we're going to pop back up to 83%. Now, you'll see that our EBITDA is going to take a little hit. Like, it's not a big hit, right? 1.616, and then we're popping back up to 1.8. So that's not bad. That's not bad. Okay. I should say EBITDA less replacement reserve, which is really our true NOI, right? So when we're talking about NOI or EBITDA in the hotel world, like, we're always looking at this line. We're never looking at this line, right? And that's because we need to factor in our 4% replacement reserve. If you're calculating value based on this line, you're an idiot. Okay. Because you're never going to see that money back, dude. Okay. Just FYI. Okay. So this is just our calculation here. Now, this is the proposal, right? So if we were, say, placing, like, Gould Capital wanted to put like 3 mil into this hotel, that would be roughly like 25 to 30% of the equity required to close. So it'd be a pretty significant amount. We might be able to negotiate some of these terms. Now, a couple things here. Like, as it stands, like, with all of these very, like, base assumptions, like, this isn't a great deal, right? But let's say that the sponsor was able to bring this down to 19 million, get a $2 million discount. Well, suddenly it starts to look a little bit better, right, than it did before. And oops, still seeing this, right? Yeah. Yeah, suddenly it starts to look a little bit better than it did before. But we can do some other things too, right? So let's see. Could we be a little bit more aggressive on the income? Probably, because a 1% growth on revenue isn't really that great, right? So look, like, we're growing. So we're not really growing these 2 years because of the displacement, right? But, like, we're going from 5,400 or 5,473 to 5,544 to 5,616, right? That's not massive growth. Now, we want to be conservative, right? So to me, this is pretty dang conservative. Like, when I look at this, I'm like, okay, we're barely growing our income. We've taken into account the PIP, the displacement from the PIP. We're paying full price for the PIP, full price for the hotel, right? Well, not really. The hotel full price would be 21 mil. Right. So we're paying full price, everything. All right. Are we losing money? No, we're not losing money. Are we making a lot of money? No, absolutely not. We're making about 11% IRR year over year. And our equity multiplier on a 7-year hold is 1.67. That's not that great. Now, I wouldn't consider this a risky buy. I would consider this pretty moderate, on the low moderate, right? Like, pretty, like, not that risky. Okay. So because the risk profile is lower, like high teens on the internal rate of return would be like very solid for this deal. But to me, this is worst case scenario, right? So of course the sponsor isn't going to share worst case scenario with us. They're going to give us best case scenario. Let's go somewhere in the middle, right? Because I think that there's definitely some wiggle room here, to make this look a little bit more attractive, right? Not just make it look more attractive, but there's I think that we can now kind of remove some of these like more conservative assumptions, to see what the upside could be, right? Because we want to make sure that we're not just like being doom and gloom guys all the time. Like let's see if like where the upside could truly be here. All right, so first thing, let's go 19 million on the purchase. I don't think we're going to be able to get anything less than that. And let's say that we're able to negotiate the PIP, right? Because that's one thing that really hasn't been done yet. So 40, like let's say that they're able to get it down to like 42,000 a key. Oops, sorry. No, four. Oh, no, one. Oh, shit. Goodness. All right. So we're going 4.2, and then 15% of that is going to be like maybe 600K on the construction reserve. Might get that back, might get it back, right? So we're able to negotiate the PIP a little bit. They're able to negotiate. I say we, like the collective we, right? Because we're all in this together. Limited partners, general partners, sponsors, like we're all in it together, right? It's a team effort. So like, let's say that we're able to get about 10K a key knocked off the PIP. The PIP, that would be pretty good. And this is probably all of the finagling I want to do here, specifically. Like, let's come back. So now we're at 25. Okay. So we're at 83 here. Looking at the star report, because this is going to reveal a lot. And these are things that we can kind of look at. All right. So how were we on ADR? Or sorry, how were we on occupancy? You see here, we were 5 of 6, 6 of 6, 6 of 6, 5 of 6, 4 of 6, 4 of 6, 3 of 6. We did not do well on our occupancy, right? Compared to the comp set. And even on ADR, we were, oops, no, goodness. I'm totally messing this up. Sorry, I'm looking at the wrong thing here. This is our occupancy, right? So we were actually 1 of 6. I was like, hold on a second. 1 of 6, 3 of 6, 1 of 6, 1 of 6, 1 of 6, right? So we actually did quite well on occupancy. I was like, hold on a second. I know that's not right. So 1 of 6, we did pretty well. And 1 of 6, we're pretty good on the ADR side of things as well. And then RevPAR, we're pretty much crushing the comp set, right? So in terms of where we're at, we probably don't have too much room to grow. The reason that we want to see that, right? So like, let's look at this. So from an occupancy standpoint, the average comp is at 65. We're at 82. So to assume now, if we were at 95 and we're 82, then we could see, okay, well, hold on a second, there's some real room for growth here in this market. Not the case. Nor is it the case really with ADR. And this is very typical of a Marriott property, by the way. So Marriott, you're going to typically see outperforms the comp set. Hilton as well, a little bit less so. Normally, you'll see Marriott usually comes in one, Hilton two, and then you kind of get the rest of them, right? And if there's multiple Marriotts in a comp set, then obviously there's going to be a pecking order there. But the reason I'm going through this right now with you is to kind of get you to see, okay, well, in my mind, do I see a path for significant growth on the occupancy side of things or with average daily rate? Not really. So 83, 83.2, 83.5, 83.7. I mean, like maybe we no. I could see, maybe the only thing here is like we go 83 and then 84 and then keep it 84 or 84.1, 84.2. I'm just kind of like making that up right now just to see if that does much. And again, this would be kind of in my mind's eye, like not the most aggressive, right? But we're now kind of like really looking at it. The other point too is if I'm getting a pro forma from a sponsor, I'm gonna like briefly look at it, but then I'm gonna do my own underwriting and I'm gonna have like a worst case scenario or like super conservative and like, a moderate assumption. I'm never gonna do best case scenario because like the sponsor's gonna give that to me. Yeah, I promise you that. So whatever they say is gonna happen, like probably not gonna happen. Right? So inflated average. So this is where come into play. The 1%. I was going to get this one talked about this 1% earlier. Could we go like? Could we assume that things move up like? Oops. Might be 1.5%. Yeah. And honestly, like, yeah. Let's look at the pro forma again. I just want to see if the movement makes sense to me. Like, I want to see this going up. Like, this isn't even 100K in growth. Like, I could see top line moving maybe 3% a year, 4%. I think I could see it moving 4%. So let's actually adjust this room's revenue. And the way that I came up with that, by the way, is post PIP, we're gonna be able to push ADR, even though ADR is going to already be fairly high for the market. We're also looking at post PIP almost 2 years out from now. So we're not really going to realize this gain. We can keep it 1 here, and then we move 4 here. And so you see now we have all of these going up 4. So we get I could see it moving up actually 5% year 1 And then I would say let's just be a little bit more conservative here. 5% year one post PIP, year one post PIP, right? Food, we're not going to worry about that. Our rooms expenses, we can just keep, we're going to assume that the operators are going to find ways, creative ways to manage expenses. And we're going to keep the expenses lower. So now this is good growth, right? 5.6, 5.8, 6.1, 6.3. All right. Now we might want to adjust our because labor isn't getting cheaper, right? Labor is not getting cheaper. So maybe we go 2% on the rooms expense just to kind of actually let's go 2% let's go 1%, and then we're going to go 2% here. Okay, this should help us on the pro forma. Yeah, we're good. I'm good with that because we're like basically at 20% 7 years out. A and G, we're at 7.26766. That's fine. That's fine. Okay. So this pro forma now looks good. So our EBITDA is going to be 36, 37. To me, okay, so to me, this is, and 42% after or before replacement reserve, that's right where we want to be. So this is not an overly aggressive pro forma. I would say that this is very moderate, just based off of the assumptions that we've made, plus knowing like, hey, we want to be somewhere in that 40% range, and that's right around where we're at. So 40% margin. So at 40% margin, and look, it's crazy how like little adjustments here like really go a long way. We're now at a 2.7 equity multiplier and internal rate of return of 21.2. And, the LP internal rate of return is going to be 18.5 and 2.3. Now, that's probably what the sponsor is going to offer retail investors. We are not retail, right? Gould Capital is not retail. So we're going to do some things, right? So let's remember this, right? LP IRR 18.5. Right? I even put it here like 18.5, and then 2.31. Okay. And let's remember these cash flows. Now, one thing I want to point out, and one thing that really excites me about this particular property is look at these cash flows. This is money in the LP's bank account every single year. So you're putting in $100,000 into this deal, right? For example, you're getting $15,000 year one, 15,400 year one, 15,500 year two. Year three, you're getting $20,000, 20,200, 20. So that's really darn good. I mean, that's really, really darn good. So, and that's the beautiful thing about these extended stays, right? You're going to get a lot of cash flow on these extended stays, and maybe the equity multiplier isn't like insane, but it's not bad either. I could think of a lot worse investments. So, as a fund manager, when I have a deal like this pop up and we get a waterfall proposal like this, I'm going to look for things that we can do to create more value for me and my group. Because we're coming in with a sizable amount of equity, let's say that we came in with $5 million on this one, right? So that we're coming in with basically half the equity that's required. we're going to be able to negotiate some terms. So like the first thing that I would come in and negotiate is I would bring this acquisition fee down to like 1%, right? And I would also ask for a 0.5% discount on the asset management fee, right? Now, let's bring this out so that you can see it. Okay. And I would say a 0.5 point, a 0.5 point on the disposition. Okay. Construction management fee, we'll just keep it as is, right? So that's that. And already looking a little better, right? Not a ton better, but a little bit better. Next thing we're going to do is we're going to say, hey, they're offering an 8% pref on this, right? That's great. We're going to bump this up 10% pref, okay? And your promote, we're actually going to bump this hurdle up to 16. So it's going to be a 16 and it'll be a 30 over 16. All right. Or actually, no, 25 over 16. And then at 20% over 20, you get your 30%. All right. So once we reach this hurdle, then you get your 30%. Right. Now notice how all of a sudden our projected IRR is now close to 20% and our equity multiplier is around 2.5. This, for moderately low risk, this is a really good upside. Keep in mind, we haven't even factored in the cost segregation on this one. Not that we would do that in the waterfall anyways, but you see all that cash flow, like most of that's going to be coming to you tax-free. Love that, don't we? So for me, this is a good deal. You know, when I look at this, like this would be a yellow green light. I wouldn't say like, hey, we're gonna for sure go for it. I would need to see, you know, I would need to talk to the sponsors, really understand the business plan, figure out, okay, who's managing the property? Are you guys going to be managing it? Are we bringing in a third party? If it's a third party, do they have experience in this area? Have they managed similar hotels before like this? Do they have audited financials that we could review as well? Because you know the biggest issue with hiring a third party management company is there can be a lack of oversight and from the sponsor to the third party management company, and you know not that they would purposefully embezzle, but they're always finding ways to put more money in their pockets, and that's, I mean, it's business, right? Like you got to find ways to make money. So we would want to make sure that the third party management company is legitimate. But I mean, this is a good deal, you know, and especially if we're able to negotiate these terms. If we weren't able to negotiate the terms, I'd be less enthusiastic about it, frankly. And if, for example, like one thing that we would for sure, like if the PIP, for example, wasn't able to be negotiated, right? And so now I mean, we're still there, right? Like we're still kind of where we need to be. But if that happened and we weren't able to negotiate price, right? Like I'm suddenly less enthusiastic about it because remember, this is best case scenario for me, right? Like when I'm looking at this is kind of like best case scenario. So I would say like the things that would need to happen in order for this to be like a for sure green light is a thorough review of the business plan with the sponsor, ensuring that the management company that they have in place is legitimate, or if they're going to be, you know, managing it themselves, that obviously they themselves have experience kind of running this type of asset, or at the very least have experience in that market, one or the other, right? Ideally both. And the last thing that we would want to do is we would want to make sure that either the PIP and the price were able to be negotiated, ideally both, but it looks like the purchase price is going to be a much larger, obviously that's a $2 million difference versus a $1 million difference on the PIP. So we'd want to see that the sponsor is able to negotiate one or both of those items. And if so, and if we're able to kind of come to terms on the fees and the hurdles and the pref, then yeah, I mean, this looks like a really solid opportunity, and I think that we would be willing to write a check for this one. So let me know if you have any questions about this. Leave it in the comments below. Like I mentioned before, if you have a hotel that you'd like me to underwrite, you can email it to me, or if you're on YouTube, email it to me. And you should be able to find my email in YouTube somewhere. Or if you are if you're on LinkedIn, put a comment and I'll DM you and you can send it to me via LinkedIn. Just know that if you want me to underwrite it, I'm going to do it live. So I'm going to do it here for all to see. If you want to redact information, you can, but I'm not signing an NDA, right, for any of those. So let me know what I would appreciate feedback. If you'd like for me to kind of go more in depth on a certain part of this, I am happy to do that for the future, for future episodes. But until then, everyone, this is Danny Gould with Gould Capital. Thanks for tuning in, and I'll catch you guys next week for next week's live hotel underwriting session.